Hey guys, welcome back to the channel. I hope you and your investments are all doing well. The Australian housing market is going absolutely crazy, and it seems like every man and his dog now want to become a property investor. But the thing is, not everyone can be a successful or a profitable property investor. In fact, according to data released by CoreLogic, there are around 2.2 million property investors in Australia, and around 70% of them are stuck on their first property. And only 1% of property investors go on to own more than 5 properties. So in today's video, we are going to take a deep dive into one of my favorite topics, how to build wealth using real estate, and how it compares to other investment vehicles such as the stock market and cryptocurrency, the pros and the cons of investing in real estate, as well as the risks associated with taking on a mortgage of hundreds of thousands of dollars, and how I personally manage my risk and mitigate that risk. This video is going to be packed full of useful information, so make sure you guys watch it till the very end so you don't miss anything. And as always, I am not a financial advisor and this is not financial advice. I am simply sharing with you my personal strategies and my personal opinion. I will always encourage you to do your own research and due diligence and seek the help of real financial experts before jumping into any big investing or financial decisions. Let's start the video by stating the obvious. Real estate investing is not for everyone. Spending hours and hours looking at properties, going to inspections, doing research on properties, saving a 20% deposit, making lifestyle changes to save that 20% deposit, and finding the right property and then managing the cash flow. Not everybody can be stuffed doing that. There is absolutely nothing wrong with renting and investing the savings into other investment vehicles like the stock market and ETFs. In fact, this is exactly what most people do because real estate has such a high barrier of entry because you have to save such a big deposit. And real estate is very illiquid, meaning you can't really take your money out quickly if there was an emergency, because the selling process takes so long. However, I personally think real estate investing is one of the greatest wealth building tools, and I have used it to help me achieve financial freedom by the age of 27. However, just because I did really well with real estate, it doesn't mean anyone who invests in real estate should expect the same results. This is because past performance does not guarantee future returns, and this is the first principle that everybody should understand before they invest into real estate or into any other asset classes. For example, just because home values in Sydney increased by 15% in the last 12 months, it does not mean it will increase by another 15% in the next 12 months. Darwin saw a growth of 21% in the last 12 months. Do you think it will grow by another 21% in the next 12 months? I think this is extremely unlikely. A lot of people enter the property market expecting to see huge equity gains or huge capital growth in a short period of time. And they expect our markets to keep growing at these unsustainable levels. And I think this is the wrong mindset to have. I could definitely be wrong, but I don't expect our property markets to keep growing at these unsustainable levels going forward. And I do expect our markets to slow down in the coming months and years as affordability constraints start to kick in, and as more and more property owners start to sell their properties and take profit. I think a lot of people that are coming into the market now are looking at property investing as a short-term thing. They expect to see huge growth in the next few years, and they want to sell that property after a few years and flip it for a huge profit. Yes, they could definitely see a lot of capital growth in the coming years, but once they factor in costs like stamp duty, holding costs, insurance, land taxes, and selling costs, as well as the cost to reinvest that money, they won't be left with a huge profit. And all of this is under the assumption that property prices will keep going up and up over the next few years. But what if we go into a recession? What if there is another major economic shock? Personally, this is why I think investing in real estate for the short term is a very bad strategy. When I look at property investing, I look at it as a long-term thing. I don't try to time the market and then sell my properties at the top so I can buy them back at a lower price at the bottom. I simply find good deals that make sense with the right rental returns, the right cash flow, and the right growth potential, and I will hold these properties for the next 20 to 30 years. Look, if you buy the perfect property in the perfect market, it is very possible for you to see 40, 50, or even 100% growth over the next few years. And that will be a great result. But let me now show you something that's even better. Let's go all the way back to 1980. An average house in Sydney cost $69,000, and the average house in Melbourne cost $39,000. If we fast forward to 1985, the average house in Sydney now costs $89,000, and the average house in Melbourne now costs $75,000. Meaning if you had purchased a property in Melbourne in 1980, you would have doubled your money. Not bad at all. However, if we now fast forward to 2020, the average house in Sydney costs $1.15 million, and the average house in Melbourne now costs $712,000. As you can see in this example, it is completely possible for you to invest in property and make a lot of money in a short period of time. However, the real wealth, the generational wealth that sets you and your family up for the rest of their lives, is built in decades, not in years. As the great Charlie Munger once said, the big money is not in the buying and in the selling, but in the waiting. Let's now talk about return on investment, because in order for us to build wealth, we want to get the highest return on investment possible. Or in other words, for every dollar that we invest, we want to get as many dollars back as possible. A very common argument is that the stock market has outperformed the real estate market over the long term. And this is true. The ASX and the US stock markets have outperformed the growth of the property market over the last few decades. Another thing to consider is that investing in ETFs or index funds is perhaps one of the easiest ways to build wealth. And it doesn't require any upkeep, doesn't require any research, and you definitely don't have to deal with any bad tenants. Property investing is definitely much more time consuming and requires a lot of research and a lot of maintenance if you want to beat the market over the long term. So why would anyone in the right mind want to invest into real estate when they can just dollar cost average into ETFs or index funds and achieve a higher rate of return?
Or they can just put all of their money into Bitcoin and expect to get 10,000% return over the next 10 years, or lose 80% of its value over a few weeks. Both have happened before.
The reason why anyone would and why I personally choose to invest in real estate is because I can use my bank's money and amplify my returns. For example, when I buy a house for $500,000 and I put down a 20% deposit, I'm essentially controlling 100% of an asset and getting 100% of the returns while only investing 20% of the money. This means for every 1% of capital growth that we see in this property, I'm achieving a 5% return on investment. This is compared to the 1% return for each 1% of capital growth that we would receive on a stock, on an ETF. There are a lot of percentages and a lot of numbers here, so it can be a bit confusing. So let's make it more simple and put it into an example. If I invest $100,000 into the stock market and achieve an average rate of return of 10% over 30 years, I will have almost $2 million by the end of the 30 years, which gives me a return on investment of around 1,900%. However, if I use the $100,000 as a 20% deposit on a $500,000 house, after 30 years with an average annual rate of return of only 7%, that house will now be worth $4 million, giving me a return on investment of 3,500%. By looking at these two examples, it is very easy to see why real estate is so much more attractive than the stock market. Another important thing to note is that this is an overly simplified comparison, and there are a lot of additional costs when it comes to investing in property and maintaining a real estate portfolio. One of the biggest expenses associated with property investing is of course interest rates, the interest that you pay on your loans. And since more than 60% of property portfolios in Australia are negatively geared, the interest repayments definitely eat into the profit margins. And then there are the other costs such as insurance, water rates, land taxes, council rates, as well as body corporate. All of these costs will eat into the profit margins and make property investing less profitable. This is exactly why I stay away from negatively geared properties, and my entire real estate portfolio is cash flow positive. It means even after paying all of the fees, the rental income is enough to put a bit of money into my pocket at the end of each month. Another very important factor to consider is that houses will deteriorate over a period of time, and it will become more expensive to maintain. A lot of people see this as a negative, but I see it as a positive. And I have set up my portfolio in a way that allows me to profit even when the houses are deteriorating. When I buy a house, I always make sure the house is structurally sound so that it can last for another 20 to 30 years. And I always make sure the house is sitting on a big block of land so that when I do decide to knock it down in 20 or 30 years time, I can replace it with 2, 3, or even 4 townhouses. I definitely don't have the money to develop these properties right now, but in 20 to 30 years time, I should have more than enough equity to help me secure those construction loans so I can develop 1 or 2 of these properties at a time. In the process, I'll be able to turn these old rundown houses into brand new townhouses, and at the same time increase my cash flow and claim depreciation on these new houses so I can minimize my tax obligations. In my personal opinion, this is the perfect retirement plan that generates consistent rental income to support my lifestyle. If you have made it this far, then my guess is that you are probably pretty bullish on property right now. However, we need to now talk about the most important part of property investing, and that of course is risk management. In order to achieve such impressive results in real estate, we need to borrow money from our bank. And when we borrow money, it comes with risk. It is the same concept as trading stocks with leverage. If you have been keeping an eye on the property market lately, then you will see the similarities, because people are taking on way more debts than they should just to get a piece of this property boom. Look, I'm not here to tell you how much debt you should be taking on or not taking on, because I am not a financial advisor and I don't know your personal circumstances. But a good way to assess your debt serviceability is to look at the long-term interest rates. As we can see in this graph, the long-term interest rate over the last 30 years averages out to be around 6%, which is significantly higher than the 2 to 2.5% that we are currently paying. So a good question to ask yourself is that when interest rates go back up to their long-term average of 6%, will you be able to afford your repayments? We can play around with the NAB repayment calculator to see what the repayments will look like when rates start going up. Planning ahead is definitely something every property investor should be doing, especially during this time of high volatility and high uncertainty. And just in case you guys forgot, there's still a pandemic going on, and the Australian economy as well as the global economy are both very fragile. If we buy and hold a property over a long period of time, history suggests that it will do very well for us. But the trick here is that we have to hold these properties for a long period of time, meaning we have to be able to make repayments and afford these repayments when interest rates start going up. Or in other words, we must have the ability to service these repayments during both boom and bust. Look, I'm hugely bullish on property over the next 30 years, and I have built my retirement plan around real estate. I have absolutely zero doubt that property is going to do well for me. Australia is a country experiencing huge population growth, and I personally believe Australia has become a favourite for overseas migrants due to just how well our governments manage their outbreaks compared to the other developed countries. Based on these forecasts by the Australian Bureau of Statistics, our population is set to explode over the coming decades, with more than 11 million people migrating to Australia by 2060. With such a huge housing shortage already, what do you think will happen when our borders open and when millions of people migrate to Australia? If you don't want to listen to me, here is what Macquarie Asset Management is doing. They have just raised $1.1 billion to invest into real estate. This is one of Australia's top asset managers, and if they see opportunity in real estate, that only makes me even more bullish. Alright guys, this brings us to the end of the video. I hope you guys got some value from this. If you did, please do me a huge favor by hitting the like button right there and commenting your thoughts. You'll be doing the channel a huge favor. And I will see all of you guys in the next video.